What if I told you that a big stock market bubble may be being fueled by the well-known market monitoring index fund? Michael Burry, a renowned investor, recently stated that on Twitter, quote, "Difference between now and 2000, also known as the dot-com crash, is the passive investing bubble that inflated steadily over the last decade. All theaters are overcrowded, and the only way anyone can get out of this is by trampling each other, and the door is only so big." But what does he mean by that? And might the seemingly benign market monitoring index fund possibly bring the stock market to its knees? Let's find out, shall we? Just to refresh your memory, buying a market tracking index fund is effectively buying a stock that symbolizes market diversification. For instance, SPY and S&P 500 index fund is the largest index fund in the world. As a result, purchasing shares in SPY will really provide investors a very small ownership stake in the largest 500 corporations in the United States. And the underlying notion is that by investing in the market, you will eventually earn a return equivalent to that of the market. In the long run, S&P 500 generates a return that, according to history, is not too bad, roughly 10 per year. As well as due to the strategy's simplicity and ease of implementation, not to mention its incredibly impressive historical annual return. It's become very common in recent years for people to engage in passive investing. According to a recent survey by Bloomberg Intelligence, passive instruments held an average of more than 20% of the shares of each firm in the S&P 500. In 2003, passive structures held about 3.3% of the market, depending on the circumstances, and given these figures, it is now being questioned whether the market would benefit from passive investment becoming so dominant. It's definitely a matter for concern, according to Michael Burry. Though recently noting the bubble in passive investing on Twitter, it's interesting to note that in reality, he has brought up the subject before. In fact, he had an email interview with Bloomberg on the subject in 2019 and highlighted, quote, that passive investing has eliminated price discovery from the equities markets. The simple thesis and models that get people into sectors, factors indexes, or ETFs and mutual funds mimicking those strategies do not require the security level analysis that is required for true price discovery. This means that as passive investment becomes popular, this will happen over time. An increasing number of shares of these large corporations are being kept by investors only for index purposes, and not because they truly enjoy the company. And over time, this causes stock values to excessively rise. Share purchases are no longer only based on how well these companies are performing on a fundamental level. Because they are in the proper index, it is actually being driven. And it is a bubble right there, one in which assets price increases for a factor unrelated to its overall performance. Therefore, the concern is whether the growing acceptance of passive investment could lead to a bubble that, if investors began to do so in large numbers, could endanger the stability of the market. In any case, the solution isn't clear as usual. As an illustration, let's go through how stock prices truly fluctuate. I mean, it's pretty clear that supply and demand determines how the price of a stock moves. Therefore, if many people want to acquire shares but few are willing to sell, the stock price will increase. Conversely, the stock price will decrease if there are suddenly many investors attempting to sell but few purchasers. Currently, each stock has a normal daily trading volume, also known as the daily average number of shares traded. And one thing to keep in mind about daily volume is that stock prices don't actually fluctuate all that much unless daily volume is suddenly greatly disturbed. However, occasionally there might be such a torrent of volume seeking to get out that it can quickly destroy the stock price, like in the case of a market crash and widespread selling. Although there won't be many buyers, there will be a lot of sellers. As a result, until additional buyers arrive to mediate the situation, the price will be set by the player who is seeking to escape in the most desperate state. When Michael Burry claims that everyone must shove past one another to leave a cinema because it is so crowded, he is referring to this situation. However, the door can only open so far. This is a nod to an old stock market illustration that explains daily trade activity. As an illustration, imagine that there are 100 people at a movie theater with the sole rule that if you want to leave, you must find someone to take your place. As a result, under normal circumstances, someone will typically wish to enter and watch a movie. However, what would happen if the theater caught fire unexpectedly? 100 individuals would be frantically attempting to escape. However, there weren't many people eager to enter the burning cinema and watch the film. Michael Burry is concerned that will transpire in the stock market. According to him, if conditions worsen further, many passive investors would attempt to exit the market and return to cash. But if everyone does this in a panic, stock values will plunge. And the unfortunate fact is that when things go wrong, solitary firms typically experience this. However, what would occur if all of the passive investors who, as you are aware, own a little portion of everything, decided to quit at once? It crashes everything, I suppose. The effect will be the same for every stock in the index, but there is a single component. Despite the fact that there is a lot of trading activity going on in and out of these passive funds, there isn't a lot of trading going on in the underlying companies that comprise the index as the other side of that coin. How is it possible? Well, the majority of ETF share trading occurs on the secondary market, or in other words, it's passive investors simply exchanging back and forth with one another. In fact, 3 years ago, Ben Felix did a fantastic video on this subject, so I want to give him a massive shout out for it. He cites 2 really intriguing pieces of proof in that video. The first comes from Vanguard and displays the proportion of ETF trading that either takes place on the secondary market or that really affects the amount of trade in the underlying securities. 94% of the transactions they discovered took place on the secondary market. To put it another way, 94% of the ETF trading volume or the positions of the underlying stock that comprise the ETF did not even touch them. What happens though if there is sudden large-scale buying or selling of an ETF? In those circumstances, ETF units are issued or destroyed, which results in trading in the equities that make up the ETF. However, it's important to note that even when you take into account creation and redemption as usual activity, a BlackRock analysis from 2017 demonstrates that this is still a relatively minor portion of all trading. In actuality, they discuss a case involving Apple, which at the time was the biggest corporation in the world. They observed that in July 2017, quote, a month which saw the large inflows to ETFs, 0.9 billion of Apple stock was traded. Although Apple was held by 331 ETFs globally, we found that at least 95% of stocks trading volume in July 2017 was not directly related to ETF flows. In other words, despite the fact that ETFs have been growing market share over the past 3 decades, they have had very little impact on the trading volumes of the underlying securities they hold. However, is there a chance that Burry is still right? Michael Burry, in all honesty, believes that the stock market will collapse within the next few years. As a result, it's a very intriguing viewpoint that prompts you to wonder how these larger index stocks with smaller cap sizes will fare if many passive investors leave the market during the next major downturn. Normally, when a minor firm is eventually added to the index, we applaud. However, this is an intriguing case where index inclusion may not be such a victory. However, having said that, please do share your opinions with me regarding the likelihood that passive investment vehicles will play a significant role in the next major stock market panic. If you enjoyed the video, click the like button, and if you want to see more, join the channel.